morning, it's Tuesday, June 23rd. I'm Sharon Nabobi, and this is Closing Price from FNDATA. We provide a daily data read on the markets for luxury and collectibles. Today's signal sits in the watch and jewelry names. On a brutal day for risk, the listed watch and jewelry retailers were among the hardest hit anywhere in the market. And yet, the resale markets for those very same goods, the markets that our data tracks, is sitting at its cycle highs. That is the gap to watch. The listed retailers on one side and the auction prices that consumers actually pay on the other. Today, that gap widened. This episode of Closing Price is brought to you by FNDATA, the market intelligence platform for insights on the art market, luxury goods, and related public equities. With a membership, you can unlock access to dashboards, reports, and cutting-edge insights to keep your finger on the pulse of the market and drive your competitive advantage. Learn more at altafndata.com/membership. The selling was broad and it was macro. The trigger was a hawkish shift in rate expectations. Both Bank of America and Deutsche Bank said today that they now expect the Federal Reserve to raise interest rates in September. That sent the dollar to a fresh one-year high and the 10-year Treasury yield up toward 4.5%, and it set off a broad de-risking. The Nasdaq fell about 4%, gold dropped more than 5% to around $4,129 an ounce, and oil fell nearly 5%. Almost nothing was spared except the dollar itself. Within luxury, the damage was uneven, and that unevenness is its own tell. The listed watch and jewelry retailers took the brunt. Watches of Switzerland closed down about 4%, Swatch off about 2%, and the American jeweler Signet down nearly 4%. The broader European houses were mixed. Richemont fell 2.2% and Burberry almost 6%. Yet, LVMH actually closed higher by about 0.5%. And the dispersion among the accessible American names was extreme, with Tapestry rising about 5%, while Capri fell almost 6% on the very same session. When two names in the same corner of a sector move 10 points apart in a day, that is due to positioning and fund flows talking, not a referendum on whether people are buying luxury. Now, turning to demand, this is the part that the equity tape cannot see. In the auction room, the watch and jewelry markets have consistently shown none of the stress that the retailer shares are pricing in. The most recent watch cycle set fresh records, including a Phillips New York sale that was the highest grossing watch auction in U.S. history at $75.8 million, and the top lots across our database continue to clear 7 and 8 figures. The retailer's shares fell today on the Fed and the dollar, but the prices that collectors pay did not move. So, the divergence is sharper tonight than it was last night. On Monday, the luxury names fell while the broad markets rose. Today, they fell along with it. But through both sessions, the watch and jewelry resale markets held firm. The read is straightforward. The listed retailers are trading as a rate and currency instruments, while end demand is measured by resale and has simply not turned. And here is the test that matters and that our data is built to answer. If resale prices for watches and jewelry begin to roll over, then the retailer's weakness is an early warning about demand, and you should respect it. As long as resale holds at these levels, a day like today is a rate story, not a demand story. The signal lives in that gap. For the data behind today's signals, the FNDATA Data Sandbox gives you hands-on access to our market dashboards and datasets, so you can test the divergence and concepts yourself. Book a demo at altafndata.com/book or reach us anytime at info@altafndata.com. I've also added a link in the description of this episode. That's it on Closing Price for today, Tuesday, June 23rd. Subscribe to be notified of new episodes, and if you love the show, please leave us a 5-star rating on Spotify and Apple Podcasts. I'm Sharon Nabobi from FNDATA. I'll talk to you in the next episode. Thank you for listening.